Hello, I'm Roderick Snell, Manager of Pacific Horizon, and I'm going to provide you with an update of the Trust, including our current outlook for the region, what we've been doing over the last full year's reporting period, and performance. So starting with our outlook, it's certainly been a challenging period for Asia ex-Japan. However, for some time, we've been highlighting four key reasons why Asian economies are generally far better positioned than in the past, especially when compared to developed markets. These are, firstly, because Asian balance sheets are in superior shape, having lacked the profligate monetary and physical stimulus of the West, especially during COVID. Secondly, most of Asia has maintained positive rates for many years, while Western markets have, for years, operated with ultra-low or even negative interest rates. Thirdly, there are no significant inflationary pressures across the region. And finally, capital flows into Asia have been negative for a decade, and the region therefore less likely and vulnerable to money outflows than in the past. The result is that today, Asia's financial position is superior to much of the developed world. Combine this with Asia's structurally faster growth rates and valuations at multi-year lows relative to developed markets, and the long-term outlook for Asian investors looks very encouraging. This, however, has not been reflected in the performance of Asian markets to date, with China the key concern among investors. Now, whilst we acknowledge the country faces several headwinds, including increasing geopolitical tensions, we believe fears of an imminent collapse of the economy are misplaced. In particular, the government has clearly moved to support the domestic economy and private companies. The regulatory crackdown on the technology sector has receded, and escalating fears over the domestic property market appear overly pessimistic. Combined with extremely depressed valuations, we've been finding a number of investment opportunities in the country, mainly focused on technology and consumer-related companies such as Baidu and Alibaba. Outside China, we continue to believe Vietnam remains the best structural growth story of any Asian economy, driven by its successful export manufacturing base. After a period of significant market weakness, driven by a corruption clampdown and funding issues in the property sector, we took advantage of share price weakness by adding to our existing holding in Vinhuan, a food processor, and made two new purchases: Mobile World, one of the country's leading electronics and grocery retailers, and FPT, Vietnam's largest IT outsourcing company. Funding came from three main sources. Firstly, reductions to India, where some valuations were looking too expensive. Secondly, reducing a number of our smaller holdings in South Korea, including battery and cloud computing companies. And finally, a reduction to our Indonesian nickel companies, where we have concerns that new processing technologies will bring significantly more battery-grade nickel to the market than investors are expecting. By sectors, it's important to note that what defines us is growth. We want to be invested in the fastest growing Asian companies over the next decade. However, we are happy to embrace growth in all of its forms. As such, we have significant positions in both cyclical growth, particularly materials and industrials, and secular growth, including technology and consumer companies. It is noteworthy that over the next year, our holdings on average are valued at nearly the same price to earnings multiple as that of the comparative index, yet they're expected to grow their earnings at nearly triple the rate. In terms of performance, as long-term growth investors, it is pleasing that over the past 3 and 5 years, our portfolio has generated significant value for shareholders. More recent periods have, however, been more challenging, as our growth style has faced numerous headwinds, including soaring inflation and interest rates. This has been combined with genuinely poor Asian markets, held back by increasing geopolitical tensions, weakness in China, and a surging US dollar siphoning liquidity from the region. Our portfolio maintains a strong growth bias, and we have faith in the long-term growth prospects of the region and believe we are well placed to add significant value for shareholders should Asian markets turn. So to conclude, we remain extremely positive on the long-term outlook for the region. Asia has already taken up the baton of global growth, with China alone having contributed more to global growth in US dollar terms than the US over the past decade, while India is overtaking Japan. Asia is now better positioned financially than much of the developed world, and with a renewed investment cycle unfolding, we believe Asian growth is likely to significantly outperform over the coming years.